Hi, this is Dan Collins, Editor-in-Chief of Modern Trader Magazine, coming to you from the floor of CME Group for Traders Exclusive. Well, the last couple of times I saw you, I talked about managed futures, and I wanted to continue that about how do you select a manager? Well, it's very common for people to say, well, performance isn't important, and I always thought that was silly. Performance is extremely important, but you have to understand how you view performance. I've been profiling managers for 15 years, and one of the key things I look at is how they perform in bad environments for them. Now, managed futures are mostly absolute return strategies, but there are good and better environments during trends. Trend followers usually give back some at the end of a trend when it ends, or in choppy bad markets. When you see these reversals, how do they do? Do they lose less than their pairs? If they're an option rider, how do they handle the spikes in volatility? You know, you can invest in an option rider and they look very good for a very long time, but when there's a spike in volatility, it usually hurts them. You're prepared for that. If you did your homework, you know when the good periods are, when the bad periods are. But if they're bad periods, if they weather those storms better than their peers and better than other people, trend reversal, if they're down 5% after 15, 20% over 3 months, well, that's pretty good. So you do look at performance. It's very good to look at performance during bad periods. Does their risk management work? Do they hold their drawdowns? And this is something, when you talk to them, remember, you should know what you expect them to do in a good period. They should tell you what to expect in a bad period. Now, the question is, we spoke last week about how you can get into managed futures through 40 Act mutual funds. That's good for retail traders to be able to do it if you're in that space. If you're in managed accounts, that's easier because you're in control of your account. Your account is with your broker, and the good thing about that is the manager will often allow notional funding. You can gear your trading to your comfort level, so you can have them trade at double their leverage or less. If you get into a conservative fund, you have to realize that while conservative returns are good, you're paying fees on that gearing. So when people lower their volatility, it's kind of an extra charge to you. So you have to look at that. And remember, if you're like most people, you're looking for diversification to your overall portfolio, which is mostly probably stocks and bonds. So you don't want to necessarily find the CTA, whether it's a 40 Act fund or a private placement with the best Sharpe ratio. You want to find them that creates the best Sharpe ratio, the best risk-adjusted return for your entire portfolio. You don't want to cut yourself off because, one of the best things about these products, like I said before, they do well what equities do poorly. So you need your alternatives to perform, to do what they're supposed to do when they do it. So if you're in a private placement, talk to the manager. One of the keys I always said, if somebody can't explain it so I can understand it, then I'm very wary of the strategy. You want someone who knows his strategy, understands it, is not moving around from strategy to strategy. Style drift is a big red flag for me when I look at people. Traders are passionate about the systems that they develop. And if they're just trying to, hook up with the popular investment, you're probably not getting the best person in that area. So if you're in private placement, talk to your manager, make sure you understand his philosophy, make sure you understand the risk. 40 Act funds, very good. Look at the volatility level. You may want to find someone who's geared a little bit higher because you're paying for the fees. So if you're paying for, some targeting 8 to 10%, that's the best you're going to do. This is Dan Collins for Modern Trader Magazine.